You may be asking yourself, how do I make myself lendable? If credit scores disappeared tomorrow, most people would panic, but banks wouldn't because your income and your cash flow will tell them way more than any three-digit score ever could. You think about how credit scores have further exacerbated wealth gaps, the miseducation of where credit scores fit into your picture of lendability, and people feeling like they've done everything right and still stuck. We're going to try to demystify some of that and get you up to speed on how things are shifting in the banking and financial world when it comes to what's really determining if you get approved for credit or not. So, the first thing we're going to go through in my notes, we're going to be talking about why credit scores have become overweighted. And then we're going to break out from there, talking about what banks actually look at. We're going to be talking about why this shift helps close the wealth gap. And we're also going to be talking about how to position yourself correctly. So stay tuned in through the whole video. So when we start talking about why credit scores have become overweighted, credit scores were created for speed and scale, not fairness. Despite what you may have heard, there's a lot of people who have tried to argue over the years that credit scores are unbiased and they give lenders and banks the opportunity to sort through potential clients and borrowers without judging them from a subjective point of view, giving a more objective viewpoint in underwriting. We know that has turned out not to be true, but they weren't even designed to do that. They weren't designed around fairness, speed, and scale. They are a threshold. They are a barrier to entry. They allow banks, institutions, lenders to have the ability to immediately file through tons of applicants and narrow down to a pool that are worth thoroughly underwriting. So they're proxies, not truths. Easy for the algorithms, not accurate for humans. So if we tie this to the wealth gap, score doesn't show job stability. It doesn't show income growth. It doesn't show financial discipline with cash. There's a lot credit scores don't show. Hence why credit score models are starting to incorporate banking data slowly but surely. But that's a different conversation for another video. So what are banks actually looking for at first? We clearly, I've put it out there that credit scores are not the bigger picture. So what are they actually looking at? So when I sit down with a client, here's what I look at before I even glance at the score, okay? Income consistency, source of income, cash flow trends, debt relative to income, so DTI, and account behavior over time. As a banker, for my consumer and small business clients, this is the big five I'm looking for. Income consistency, source of income, cash flow trends, DTI, debt relative to income, and account behavior over time. How you're managing that money once it's in your hands. So a 680 score with a strong beat is way better than a 760 score with weak cash flow. A 680 credit score with a strong income is going to beat a 760 score with a weak income every single time. Every time. And I'm telling you this from real world experience. So scores punish people who don't grow up with credit. It goes back to the fairness part of the conversation. There's components to achieving a great credit score, although the starting line is different for a lot of people. We know that credit in different variations and ways can be passed down. So if I inherently grow up in an impoverished environment or an environment with poor credit scores, before I even get out of the gate, I got a bad start. So it doesn't tell a full story. Income and cash flow, however, reward responsibility because that's way more of a personal choice. It can be impacted by environmental components, but it's much more of a personal choice. Renters, gig workers, and entrepreneurs benefit from this shift. Income being used to better complete the picture of an underwriting profile or a loan application. again, if you're a renter, a gig worker, entrepreneur of some sort, you can benefit from this if you're smart and position yourself. You can, because you have the opportunity to have some strong control over your income in most cases. A lot of times, this tends to be the group who take on more risk and tend to have credit scores that have been credit profiles that have been through more a lot of times. So you have an opportunity to leverage the fact that you might be working extra, that you might be able to increase your prices, etc., to balance that picture out when it comes to your inflows, your income, your cash flow, if you're an entity, whatever the case may be. So this is why newer underwriting models matter so much. They finally see people and not just profiles. This is key. So if you are my client, this is exactly what I tell you to do over the next 90 days. So pay attention. Stabilize your deposits. Reduce income volatility where possible. Don't overdraft. Please don't do that. Show predictable inflows. Keep balances steady. This is the framework that's going to allow you to paint a very rosy picture of stability, predictability for lenders when they go to assess you for any lending opportunities. Again, if you got that 680 that we just talked about and you meet these metrics, you got stabilized deposits, you have reduced income volatility, you have an overdraft, you've shown predictable inflows, and you keep balances steady, your 680 is going to get approved every time over the 760 that is messing these 4 or 5 metrics up. That could be your 90-day plan if you're looking to work your way to accessing capital for whatever reasons. This includes even credit cards. This is your opportunity, your basic framework by bullet point for you to start working on if you're looking to access capital in the next 90 days or so. So credit scores open the door. Let's be fair. They're not completely irrelevant. They do open the door. Income and cash flow decide how wide those doors open. Income and cash flow decide how wide those doors open. So if this helped you, subscribe down below. The next video, we're going to be taking a look and breaking down how banks rank customers internally and why most people never know where they stand. So we're going to get a better glimpse how banks are ranking you internally and why a lot of times you never know where you even stand with the banks. So make sure you're tuned in for the next video. So all my pioneers, welcome back. To my new viewers, welcome in. Comment down below. Let me know what you learned in this video. Let me know what experiences, good, bad, or indifferent, you can add to the context of this video, how your credit score has helped you or hurt you, how you've been able to navigate using your income, inflows, cash flow balances to favor you in lending decisions, even when your credit score wasn't the best. Add to this conversation down below. I know you have stories. Other than that, I want you to get in the description section, time with me on Instagram and TikTok. For those of you who are new, I'm an active relationship banker, small business banker by trade, financial services professional. I've been in the field for over 14 years at the time of this recording, managing a book of business of $25 million in consumer and small business deposit relationships, and an even bigger one with investments, and that's not including the lending relationship portions of the relationships. So you're dealing with somebody who's actually taking this insight, this information, strategies, and applying it with my clients in person and helping them increase their net worth and grow their businesses every single day. And I'm bringing it to you on this channel. So make sure you support the channel. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.